The United States is gearing up for a busy week in the financial markets, with key events such as the release of the Federal Reserve, Fed, minutes and the highly anticipated non-farm payrolls report. While early indications suggest a potential slowdown in the labor market, the broader outlook remains positive for the U.S. economy, which continues to outperform its global counterparts. This article examines the potential impact of these events on the U.S. dollar and explores factors that could shape its future trajectory. The U.S. economy has demonstrated a robust performance in recent months, characterized by steady economic growth of around 2%, a remarkable recovery in the housing market, and a healthy job market. Furthermore, inflationary pressures have shown signs of cooling off, albeit at a gradual pace. Consequently, investors have priced in a scenario of prolonged low interest rates, with market expectations suggesting a potential rate hike by the Fed in September and the possibility of another increase thereafter. The prospects of rate cuts have been pushed further into the second half of 2024, reflecting diminished concerns of an impending recession. Despite the positive narrative surrounding the U.S. economy, the U.S. dollar has struggled to capitalize on these developments. Throughout June, the strength of the euro and the British pound, driven by central bank actions, hindered the dollar's performance. This raises questions about the dollar's ability to leverage the shift in market sentiment and suggests a potential vulnerability that could be exposed during the upcoming events. The focus of the week will be on the non-farm payrolls report, which is expected to show a slight decline in job growth in June compared to the previous month. Nevertheless, the projected figure of 225,000 jobs indicates a healthy labor market and ongoing tightening. Additionally, the unemployment rate is forecasted to decrease to 3.6%, while wage growth is expected to moderate to 3.6% on a yearly basis. Early indicators point to some softness in June's employment data, with surveys suggesting weaker employment growth and an increase in initial jobless claims. Should non-farm payrolls come in below projections, the dollar could face some temporary weakness. On the other hand, an unexpectedly strong employment report, especially in wage growth, could rejuvenate the dollar as market participants reassess the probability of further rate hikes. Such a scenario may cause the euro-dollar exchange rate to decline, potentially retesting the 1.0840 support level. Looking beyond the immediate events, the outlook for the U.S. dollar appears favorable. The fundamental driver for its strength lies in the relative economic performance of the United States compared to the Eurozone, with the former showcasing a superior position. If business surveys warning of a declining European economy materialize, the gap between the two economies could widen further, bolstering the dollar. Additionally, a potential correction in riskier assets and a return of risk aversion could prompt defensive flows into the dollar, further supporting its position as a safe haven currency.